Imagine taking your final exams and getting a flawless 100% on every single test.
Right, you do all the extra credit.
Exactly. You do the extra credit, your presentation is perfect, and then, the school expels you anyway.
Which just defies all logic. You did exactly what was asked of you, you performed perfectly, and you still get punished.
Yeah, that is exactly what just happened to one of the biggest software companies on the planet.
It really is a crazy situation.
It is. So Adobe just dropped their Q1 fiscal year 2026 earnings. And they didn't just meet Wall Street's expectations. I mean, they completely crushed them.
Across the board.
We're talking billions in cash, record-breaking margins, just total beats everywhere. And the market's response to all this good news, they wiped out billions of dollars in Adobe's market cap overnight.
Yeah, a nearly 7% drop practically instantly. It's a textbook financial anomaly.
Welcome to the Deep Dive. Today we're making sense of this glaring paradox. We are synthesizing a massive stack of fresh sources for you to try and figure this out.
And we've got some really good ones today.
We do. We're looking at the actual Q1 earnings call transcripts, market analysis from Market Beat and Stock Story, incredibly detailed valuation models from Guru Focus, and we're even bringing in deep-cut blog comments from actual working design professionals.
Because the numbers on a spreadsheet, well, they only tell you what happened historically.
Right.
The human behavior, how traders, analysts, and actual users react to those numbers, that tells you why it happened and, more importantly, what might happen next.
Okay, let's unpack this. Because reading these Q1 numbers, I mean, it feels like looking at a corporate fairy tale.
They are very strong numbers.
They pulled in $6.40 billion in revenue. That is a 12% year-over-year growth. And the profit was just as massive. But the margins are what really make my jaw drop.
Oh, the cash flow margin is incredible.
Almost 26%.
Yeah.
Nearly half of the money coming in the door is turning into pure free cash. They generated almost $3 billion in cash in just 3 months.
And when we talk about that revenue growth, it's really worth pausing on a specific metric from the earnings report. They reported an 11% growth in constant currency.
I always see that in earnings reports. That basically means stripping out the exchange rate fluctuations, right?
Exactly, yeah.
Because Adobe sells all over the world, if the U.S. dollar gets super strong, it makes their international sales look weaker on paper, right? Even if they sold the exact same number of software subscriptions in Europe or Asia.
You nailed it. It shows the core business is actually growing organically, not just benefiting from a favorable currency exchange rate.
Got it.
And the same goes for their profit. They reported a non-GAAP earnings per share of $6.06, which handily beat the consensus estimates of $5.88.
And non-GAAP just means they're pulling out one-time accounting expenses, right? Like stock-based compensation or restructuring costs.
Yeah, exactly. It's to show you the actual day-to-day operational cash generation of the business. And by every single one of those metrics, the operational engine is just absolutely roaring.
So we have a company pulling in mountains of cash, beating the Wall Street estimates on both the top line, which is revenue, and the bottom line, profit.
Right.
This brings me back to the A-plus student getting expelled.
Yeah.
How does a company perform this well, offer strong guidance, and still get punished by the market?
It's the ultimate question.
I mean, share prices tanked. They landed in that $252 to $269 range right after these results were announced. Why the massive disconnect?
Well, to understand the drop, you really have to look at the mechanics of how Wall Street values a company, particularly in the tech sector.
Okay.
They don't price a stock based on the cash you made yesterday. They price it based on the velocity of the cash you might make tomorrow.
Interesting.
And when you look past the immediate earnings beat, you see a really clear deceleration trend.
Okay, a slowdown in the rate of growth, like a car going from 80 miles an hour down to 60. It's still moving fast, but it's letting off the gas.
That's a great way to put it. The stock story analysis maps this out perfectly. Adobe's 5-year revenue compound annual growth rate, so their long-term historical average, is 12.3%.
Okay.
But if you look over the last 2 years, that annualized growth dipped to 10.8%. And the forecast, analysts are projecting an 8.6% growth rate over the next 12 months.
Ah, so the engine is undeniably losing RPMs.
Exactly.
But let me push back on that. Why does a drop from 12% to 8% trigger a massive sell-off?
It sounds like an overreaction, right?
Yeah. I mean, they are still growing, and they are massively profitable. Most traditional companies would literally kill for 8% growth with 46% cash margins.
They would. But it's because of the sector they're in. Software companies are traditionally valued at a massive premium compared to other industries.
Because investors assume their growth will scale exponentially, since software costs almost nothing to duplicate once you've built it.
Right. So when a software giant starts decelerating, investors panic. It suggests the market might be fully saturated, like everyone who needs Photoshop already has it.
Right, there's no one left to sell it to.
Exactly. But more importantly, this deceleration is colliding with the single biggest disruption the tech sector has ever seen.
Generative artificial intelligence.
The absolute core of the uncertainty right now.
Which brings us to the AI gamble. And looking at the sources, I'm trying to figure out if AI is going to be Adobe's catalyst for a whole new era, or the cannibal that just eats their core business.
It's the big debate. But the numbers do show a massive pivot. Their AI first annual recurring revenue more than tripled year over year.
Wow, tripled.
Yeah. Their generative AI tool, Firefly, hit an annual recurring revenue of over $250 million.
And look at how they are acquiring those users. I noticed they didn't just try to sell a new expensive enterprise package.
No, they went a totally different route.
They pushed freemium web and mobile versions of Adobe Express and Firefly out to the general public.
Right, and the monthly active users on those freemium platforms crossed 80 million.
80 million.
Yeah, that is a 50% jump. They are even partnering with Major League Baseball to use these enterprise AI tools.
And I was reading about how this actually works mechanically, and it's wild. Imagine an MLB social media manager sitting in the dugout. A player hits a walk-off home run.
Okay.
Instead of waiting an hour for a graphic designer back at the agency to build a promo image, the social manager just types a text prompt into an Adobe AI tool right on their phone.
Wow.
Yeah, and it pulls the official team logos, matches the exact brand colors perfectly, and generates a broadcast quality graphic in like 15 seconds.
Which completely changes the velocity of content creation. It saves the MLB thousands of dollars in agency fees and gets the content out to the fans instantly.
Here's where it gets really interesting, though, and frankly, a bit concerning for their bottom line.
Oh, definitely.
If Adobe is pushing all these freemium web and mobile versions, giving away these incredibly powerful tools for free or very cheap, aren't they just acting like a Michelin star restaurant, handing out free, world-class appetizers on the sidewalk?
That's a really good analogy.
At what point do people just eat the free appetizers and refuse to go inside and pay for the $50 steak? Are they cannibalizing their own core paying subscriber business?
What's fascinating here is how violently divided Wall Street is on that exact question.
Really?
Oh, yeah. You have analysts sounding the alarm over something they are calling the saucepocalypse.
The saucepocalypse. That's dramatic. Break that down for me.
Yeah.
Why would AI kill the software as a service model?
Well, because the traditional SaaS model, especially for creative tools, relies on a steep learning curve.
Oh, I see.
You pay Adobe a premium every month because Photoshop is a highly complex instrument. It takes years to really master it.
Right.
But if a competitor, let's say a nimble startup like Canva or Figma, integrating with a powerful AI model like Anthropic, allows a user to just type, "Make me a modern website layout for a coffee shop," and the software does it instantly.
Then the value of knowing how to use complex software drops to zero.
Exactly.
So the fear is that generative AI commoditizes the actual skill of design. If the software does all the heavy lifting, nobody needs to pay a premium for the professional-grade tool. That's the cannibal argument.
And that fear is exactly why the stock is so volatile right now. But Adobe's enterprise data tells a totally different story. That's the catalyst argument.
Okay, what's their counter-argument?
They are betting that giving away the free appetizers will actually build a massive top-of-funnel pipeline for their real moneymaker, which is the enterprise ecosystem.
Okay, I can see that. If I'm a massive corporation, I don't just need one graphic for a single tweet.
Exactly, you need way more.
I need tens of thousands of assets managed, legally cleared, and distributed globally across 100 different campaigns.
Right. And the ARR for their Gen Studio family of products grew over 30%. They currently have 650 enterprise trials underway for tools like brand concierges and LLM optimizers.
Wait, what is an LLM optimizer in the context of Adobe? How does that actually work for a corporation?
Think of it this way. A large language model, or LLM, is generally trained on the whole open internet.
Right, like ChatGPT pulling from everywhere.
Exactly. But a global brand, like Coca-Cola, needs an AI that only generates images using their specific trademarked shade of red.
Oh, that makes sense.
They need their specific font, and they need legally cleared assets so they don't get sued for copyright infringement.
Right, they can't just have an AI spit out something random.
Exactly. An LLM optimizer essentially puts a secure corporate fence around the AI.
I love that visual.
Adobe is telling these massive companies, we will give you the AI, but more importantly, we give you the secure infrastructure to manage your massive, complex content supply chains without the massive legal risk.
Ah, so they trade short-term individual subscription losses for massive multi-million-dollar corporate contracts?
That's the playbook.
But for them to survive this transition period, they really need their current subscriber base to stay put. They need that massive cash flow to fund the whole AI revolution.
They absolutely do.
Which brings us to the Pro Design Tools data and a really critical question about Adobe's current dominance.
Ah.
41 million paid Creative Cloud subscribers. That is just a staggering footprint.
It really is. But if you dive into the user comments on these industry blogs, the sentiment is incredibly hostile right now.
It really is.
Mhm.
I mean, users are actively debating what they call the hostage model.
Right, that feeling of being trapped.
It's this feeling of a subscription for life that you can never escape. And I'm seeing commenters point out that independent studios and freelancers are actually migrating.
Yeah, they're jumping ship.
They are jumping to cheaper perpetual license alternatives. Software like Affinity Photo or DaVinci Resolve, where you just pay a flat fee once and you own the software forever.
Which makes complete economic sense for an individual freelancer who's watching their overhead.
Let's be real. Nobody likes paying a monthly bill forever. I was reading these comments, and it feels like Adobe has become the digital equivalent of the local water company.
It's a funny way to look at it.
You might hate the bill, you might complain about the rate hikes, but you can't exactly turn off the tap if you want to run a creative business.
Right.
But if people can turn off the tap with tools like Affinity, does Adobe actually have a monopoly, or are they really vulnerable here?
Well, if we connect this to the bigger picture, we really have to separate the vocal frustration of the individual freelancer from the reality of the global enterprise.
Okay, break that down.
A solo wedding photographer might switch to a cheaper alternative to save $60 a month, but look at the enterprise reality. 99 of the Fortune 100 companies use Adobe.
99 out of 100. That's not just a market share. That is the entire industry standard.
Exactly. Let's look at the mechanics of why that matters so much. Think about the Super Bowl. During the game, Adobe's platforms handled more than 8 billion analytics server hits and 216 million emails for various brands.
Wow.
When you are a global marketing department managing that level of scale, your switching costs are astronomical.
Because it's not just about installing a new app on a laptop.
No, not at all.
It's about retraining 5,000 employees, migrating millions of proprietary files, rebuilding your entire digital supply chain, and hoping the new system doesn't crash during your biggest ad campaign of the year.
The switching costs are practically prohibitive, and the financial metrics from the earnings call prove this. Adobe's customer acquisition cost payback period is 33.5 months.
Okay, so what does that mean in plain English?
It means once they spend the marketing dollars to acquire a new enterprise customer, it takes less than 3 years to earn that money back.
Oh, wow.
After that, it's just pure profit. But the real staggering number is their remaining performance obligations, or RPO, which is sitting at $22.22 billion.
Wait. Let me make sure we're totally clear on that. What does that $22 billion RPO number actually mean for you if you're holding this stock?
RPO is basically contracted revenue that hasn't been recognized yet. It's guaranteed future money.
Okay.
So a massive advertising agency signs a 3-year contract for Adobe's Enterprise Suite. That money goes into the RPO backlog until the service is actually delivered month by month.
Oh, I see.
Having over $22 billion in the pipeline shows that large businesses are completely locked in.
So the hostage model might be a harsh reality for individuals complaining on Reddit, but from an investment standpoint, it represents an incredibly deep, sticky economic moat.
Exactly. It's a huge safety net.
So we have this incredible tension, a company with an undeniable moat, $22 billion in guaranteed future cash, but facing this existential AI threat and slowing top-line growth.
Yeah, it's a lot of moving parts.
Figuring out what this stock is actually worth today feels like an impossible puzzle, especially because right in the middle of all this technological chaos, they decided to drop a massive leadership bombshell.
Tucked right into this earnings call was the announcement that Shantanu Narayan, the CEO, who has led Adobe for over 18 years, is stepping down.
18 years. I mean, In the tech world, an 18-year tenure is a dynasty.
It really is rare.
He's the guy who successfully navigated them through their last massive transition, moving the company from boxed CDs you bought at Best Buy to the cloud subscription model.
A transition that Wall Street also hated initially, by the way, but it turned Adobe into the financial juggernaut it is today. And now he is leaving right at the precipice of an even bigger shift.
It's like they've spent 20 years building the world's most profitable, dominant toll road.
Great.
And suddenly, they have to figure out how to monetize flying cars.
That is a great visual.
The infrastructure they dominate today might not be the infrastructure people use tomorrow, and the guy who built the toll road is handing over the keys.
Which is terrifying for investors.
When you factor in that execution risk, the valuation data we are seeing from analysts is just completely schizophrenic.
The divergence in how the market is pricing Adobe right now compared to its competitors is honestly wild.
Let me run through these numbers from the sources because we need to compare this to the broader sector.
Wait for it.
The stock's price to earnings, or PE ratio, is sitting at 16.14. Now, for context, a lot of high-growth software companies trade at a PE of 30, 40, or even 50 times their earnings.
Yeah, much higher.
So 16 looks insanely cheap. And their PEG ratio, which compares their price to earnings against their actual growth rate, is sitting at 1.08.
This raises a really important point. A PEG ratio near 1 essentially implies the stock is perfectly, fairly valued based on its current growth.
Okay.
So it's not overvalued at all according to that specific metric.
So you take those fundamental metrics, the cash flow, the low multiple, and you plug them into the Guru Focus algorithm, and it basically screams buy.
Right. The algorithm loves it.
It rates the stock as significantly undervalued and gives it a target value of over $608 a share.
But then you look at the human analysts at the major Wall Street banks.
Yeah, right. Barclays slashed their price target to $335. TD Cowen dropped theirs to $325 and kept a hold rating.
Which is a massive drop.
And Weiss Ratings actually downgraded the stock all the way to a sell. So what does this all mean? We have an algorithm saying it's worth $600 and major banks saying it's barely worth $300.
It's like having two mechanics look at your car.
Yes. One says it's a classic worth a fortune, and the other says sell it for scrap. How do we reconcile this massive gap?
Well, we reconcile it by understanding what each side of the market is weighting the heaviest.
Okay, tell me more.
The algorithms and the bullish investors are looking at the foundational floor. A 16x PE ratio for Monopoly with 46% free cash flow margins is historically unheard of in the software sector.
It's a massive bargain on paper.
Right. And Adobe's board knows the stock is cheap, which is exactly why they just announced a massive $25 billion stock repurchase program running through 2028.
Let's explain the mechanics of that buyback, because $25 billion is a staggering amount of capital. When Adobe takes $25 billion of its own cash and buys its own stock off the open market, it effectively destroys those shares, right?
Yes,
It
exactly.
reduces the total supply of shares available.
Yeah. If you own a slice of a pizza and the pizza suddenly gets cut into fewer, larger slices, your slice just got more valuable.
I love that.
It's management setting a floor on the stock price and basically signaling to the market, hey, if you won't buy our stock at this cheap valuation, we will.
Okay, so the buyback provides a massive safety net. Why are the human analysts slashing the targets then? What is the psychology of an analyst issuing a sell rating on a company that just printed $3 billion in cash?
Because algorithms don't price in human uncertainty. Wall Street absolutely despises a vacuum of leadership. The rising short interest we saw leading up to this earnings report, meaning traders actively borrowing shares and betting money that the stock price would fall. That proves that the market doesn't trust the transition. The banks are cutting their targets not because Adobe isn't printing money today, but because navigating the AI shift requires perfect product strategy, perfect pricing, and perfect execution.
And doing that without your visionary, 18-year CEO raises the risk profile dramatically.
Exactly. It's a huge execution risk.
So bringing this all together, what is the ultimate takeaway for the listener today?
Well, I'd say Adobe is a company caught in the middle of a massive tug of war.
Yeah, they are fighting a war on two fronts. On one side, they have to keep the Fortune 100 companies locked into their complex, expensive supply chain tools.
Right, defending the moat.
And on the other side, they are desperately trying to capture the next generation of creators with free AI-powered web apps before those creators get scooped up by nimble AI-native startups like Canva or Midjourney.
It really is the ultimate battleground stock right now. The financial metrics are pristine, but the structural foundation of their entire industry is shifting underneath them.
It's crazy to watch.
That nearly 7% stock drop isn't a reflection of a bad quarter. It is simply the discount the market demands when you introduce severe leadership uncertainty into an already volatile technological revolution.
It really makes you think about the long-term end game here. I want to leave you with a brand new concept to ponder as you go about your day.
Okay.
Think about the ultimate promise of generative AI that companies like Adobe and all their competitors are rushing toward.
The promise that creation becomes totally frictionless.
Right. If that promise is actually fulfilled, if making professional-grade graphics, marketing videos, and web layouts becomes as easy as just typing a descriptive sentence into a chat box, does software like Adobe become the universal, inescapable utility for the entire world?
Like, does it just become the electricity that powers all visual communication?
Or is there a flip side to that fictionless future?
I think there definitely is.
If the AI does all the heavy lifting, if literally anyone can generate a masterpiece in 10 seconds, does the very concept of a creative professional, the exact person who forms the core of Adobe's subscriber base today?
Do they cease to exist altogether?
Yeah. It is the ultimate paradox. In their race to build the ultimate creative machine, they might accidentally eliminate the need for the professionals who historically paid a premium to operate it.
If the skill is in the machine, you don't need the craftsman.
And right now, Wall Street isn't entirely sure if Adobe is selling the machine or if they're just the craftsmen about to be replaced.
It's a really good question.
A lot to think about if you're holding those shares. Thanks for joining us on this deep dive. We'll catch you on the next one.